Hey everyone, and welcome back to Everything About Accounting. We've already covered accounting, assets, and liabilities. Now it's time to understand another key piece of the puzzle, equity. In simple terms, equity represents the owner's stake in the company's assets after deducting liabilities. Think of it as the net worth of the business. What would be left for the owners if all the assets were sold and all the debts were paid off? Let's go back to our lemonade stand. If you bought $100 worth of supplies, an asset, using $40 of your own money and $60 borrowed from your parents, a liability, your equity in the lemonade stand is $40. It's your ownership stake. For corporations, equity is often referred to as shareholders' equity or stockholders' equity. It includes things like common stock, the value of shares issued to owners, and retained earnings, profits that the company has kept and reinvested in the business. For sole proprietorships or partnerships, equity is usually called owner's equity or partner's equity and represents the owner's capital contributions and accumulated profits. The fundamental accounting equation highlights the relationship between these three core elements. Assets equals liabilities plus equity. This equation is the foundation of the balance sheet and shows how a company's resources are financed. It provides insight into the financial stability and ownership structure of a company. So, to summarize, equity is the owner's residual claim on the company's assets after all liabilities have been paid. It's the ownership interest in the business and a key component of the accounting equation. There you have it, equity explained in under 90 seconds. Are these fundamental terms becoming clearer? Let me know in the comments. And don't forget to subscribe for more bite-sized accounting lessons. What terms should we explore next? Thanks for watching, and I'll catch you in the next video.